We had,
And then I'll pause.
hi
All right.
Amanda.
Welcome everyone to the live Trade Machine Help, which is via video twice a week. It'll be Tuesdays at 11 a.m. Pacific, 2 p.m. Eastern. So during market hours on Tuesdays. On Thursdays, it's after market hours for people who have different schedules. So it's 4 p.m. Pacific or 7 p.m. Eastern, as in now. You also have Max every trading day in community. I'll show you how to do that. You don't have to, if you don't feel comfortable, if you don't want to watch live videos, if you don't like live video, if you don't like asking questions live video, just you can ask Max in chat. I'm gonna each live help will be purposeful. So I'm gonna do something and then we'll do Q&A. Okay. So let me do that. Oh, sorry. My name is Ophir Gottlieb. I'm the CEO of Capital Market Laboratories. I'm a former option market maker on NYC, ARCA, and SIBO. I'm a former hedge fund manager, former managing director of quantitative research for a company that was purchased by MSCI, patent holder of the fraud swap, Stanford mathematician. That's Max Katz, former commodity option market maker for almost 2 decades across several different exchanges as the world changed with exchanges, ending up on the New York Board of Option Trade. He's also been a Trade Machine member for 6 or 7 years, and so
Seven.
he's 7 years. So he's kind of our face in community, like our ambassador member, and he's clearly here on Live Help. Okay.
Can I
If anyone wants to know more about me, I have a whole bio, but I don't want to, I'll just send you a link. Okay. All right.
can I just interrupt you for a quick second to say that Trader Susan is here, so I have to be on my best behavior. I
Hmm.
want her to know that I wore my white shirt and red tie
Yeah, tighten it up. Tighten it up, Max.
just in case she showed up.
Tighten it up, Max. Tighten it up. All right. I'm going to stop sharing my video. You should hypothetically see my screen. Max, why don't you kill your video and do you see my screen?
I
You
stopped
see?
mine.
Yeah, do you see my screen?
Yes, I do.
Excellent. All right. Friends and family, let's do this. First, the disclaimers. The results here are provided for general information purposes as a convenience to you, the viewers. The materials are not a substitute for obtaining professional advice from a qualified person, firm, or corporation. This is not a solicitation to buy or sell any security ever. And even further, this is not advice. Past performance is not necessarily indicative of future results. All right, I am going to start this webinar the same way every time, and we're going to be doing help for the next 2 decades, and it's always going to start the same. So get comfortable with these slides. Number one, to be a successful trader, you need to focus on the long arc of a career, not on Thursday, not on a Wednesday, not on a February, not on a December. Take a deep breath. It ain't a sprint. You will need a process, which most people in finance call a plan. Trade Machine was built for this. It's exceptionally good at this. If we were not human beings and we were machines, in fact, all you would need is a process. Because what is a process? A process is what to trade, when to open the trade, and when to close the trade. And if you think about it, that's all you would need, right? If I knew what to trade and when to trade it, when to close it, I'm a successful trader. But you are human. I think you're fortunate to be human. So it isn't enough to just have a process plan. Otherwise, I could sell Trade Machine as the end all be all, but I cannot do that because I'm too honest. And Trade Machine is not the end all be all. And just being a Trade Machine member will not make you wealthy. It will not make you a successful trader. You will not be this just because of Trade Machine. And you say, well, why not? Because you need two other things, and those things Trade Machine can't give you. Like what? Like patience. For some, patience is easy. For some, patience is hard. You have to have patience in your plan and yourself. Believe in yourself enough to have patience with yourself. Okay. And you say, well, okay, I happen to be a patient person. I'm not, but you might be saying that. So if I happen to be a patient person and I have trading machine, does that mean I'm going to be successful? Not enough. You're also going to need to put in the effort. And effort has two parts. The first part you're not going to like. It's probably going to be harder than you think it will be. And I know that's different than everything you see on YouTube. When you see a signal and they just follow their AI, you have 60 to 80% win rates and you'll just be rich. And it just isn't true. You must know somewhere deep inside of you that that isn't true, right? There must be something, some part of you that sees that as like, that's just not real. So that's the bad part of effort. It'll probably be harder than you think, but there is a good part. If you're able to get past it being harder than you think, it's probably going to be more satisfying than you think. And that's just the nature of humanity. When things are harder than we think, but we do it, it's more satisfying. It just is. So that's what it takes to be a successful trader, focusing on the long arc of a career. Process, patience, and effort. All right. Last sessions, we talked about when a stock has dropped and it might recover. So we did the spread the sell-off plus AI. We looked at tech with NASDAQ 100 and financials. We looked at buy the sell-off with AI. That's also when a stock has dropped and might recover. And then we looked at tech, financials, and healthcare. I started expanding how to look at various industries and sectors so you can have a portfolio of alerts or trades. Then we looked, kind of changed things and said, okay, it's no longer when a stock is dropped might recover. It's when a stock is above its 50-day moving average. And we're actually looking for like a bullish continuation of bullish momentum, or what I call optimism, with the pre-earnings momentum diagonal. I looked at tech, financials, and healthcare. We looked at multiple time frames. And I also showed you when something does not work. Oh, sorry. Then I did fade the dip. Pardon me. That's when a company is recovering its 200-day moving average has gone from technical failure and it's recovering. Okay. We looked at 4 different sectors. I showed when maybe you shouldn't do something in an entire sector. I showed you, for me, when an entire sector behaves in a certain manner over 3 years, I'm just going to skip it for the year. In other words, I'm going to do fade the dips plus AI in 2024, but I'm not going to do any in the NASDAQ 100. And I said, why? These are all available for recording. So if you're wondering why, you could just watch. Now, one thing I said last time was this. I want to do this again. So that's what I'm going to do tonight. I'm going to do spread the sell-off plus AI again. I got better after I did these. And I was like, I didn't do this justice, in particular because this is the most difficult one. So I bit off more than I could chew. Not unlike me. So that's what we're going to do today. All right. No more slides. You're welcome. We'll just do TradeMachine. So we are going to go to the backtest tab. We are going to go to saved backtests. Everyone has this. Everyone has these saved backtests. You can add your own, but everyone has these. And tonight we're going to do spread the sell-off with AI. It's a put ratio spread, a 1/3/2. I'm going to explain that better than I did last time, but just for nomenclature, that's what we're doing. And you just click load and let it do its thing. It's going to load a single ticker. It loaded Amazon, no problem. You'll notice that it loaded Amazon for 3 years, but the 3 years ending in October. But I want the 3 years ending now. So I'm just going to click the 3-year button. Okay, we'll just start with one ticker before we go to portfolios and look at different sectors. Okay. All right, now you'll notice that this is up to the current date. Great. Before we start looking at how this goes on portfolios and why it works and why it doesn't work, let's first just try to understand what's going on. First things first, when does this trigger? We don't even know what we're doing yet, but let's just know when it triggers before we do whatever we're about to do. So you can see it right here. I actually like to go to the technical open and just look at it that way. It's the same information. It's just easier for me to look at it this way. So, okay, when does this thing happen? Having not defined what thing is. There's some trade we're going to do. I haven't said what the trade is yet, but I know that these things have to happen first. These 4 things have to happen, and all of them have to happen for it to trigger. So it's their and. This, and this, and this, and this. Number 1. In the last 30 days, the stock is down 10% or more. Okay, so we're looking at a stock which in the last 30 days has corrected. In market jargon, a correction is when a stock is down, well, when a stock or a market is down 10% or more. We call that a correction, and then more than 20% we call a bear market. So this stock has corrected. It's down a fair amount in 30 days. That's number one. Number two, so also the stock is below the 200-day moving average. In my speak, when a stock is below the 200-day moving average, I consider it in technical failure. So the first, just we have two more things to do, but the first two elements of this are one, the stock is dipping pretty hard in the last 30 days, and the stock is in technical failure. Those are two things. Now I need a third thing. And the 6-month asymmetry of returns, so the skew, is negative, which means that the probability distribution, the returns are leaning to the left, right? There's more downside days than upside days in the last 6 months. Okay. If you want to learn more about skew and things like that, you can click that. There's a whole video which really explains at least a portion of our AI. I don't give the full algorithm, but a portion of our AI. So 1, 2, 3. And then the fourth thing we need is in the last year, the tailedness of returns is below zero. That means when there's a really big move for the stock, a tail move, it's bigger on the downside than the upside. So this stock is really in trouble. This stock is in trouble. This stock is in a correction. It's in technical failure. It's asymmetric to the downside. And when it has big days, the big days tend to be bad. This is pretty bad. Okay, that's the technical open. And that's why the strategy is called spread the sell-off. The sell-off part is what we just looked at. This is a sell-off. This is a downright, straight down the middle stock that is selling off in almost every way you can measure it. Okay. There is a closing rule before we even discuss what the trade is that says at 80% gains, close it. You're done. You're out. Okay. That's what TradeMachine says. If you have an 80% gain, again, I haven't even told you what the strategy is yet. I'm just telling you whatever the strategy is. If you have an 80% gain, close it. And the last rule is never trade earnings. And never trade earnings means this. I'm going to draw a little picture for you. Let's say earnings are right here. Okay, let's say this is a timeline. I know I'm drawing with my hand and that looks terrible. And each tick is a day. Okay, so days. Okay, and I'll just to make it clear, this is earnings day. This is earnings day. What never trade earnings says is this. This period of time, sorry, I should have included that. Fix that. The period of time 2 days before earnings, all the way to 2 days after earnings, that's a no. It doesn't matter if it triggers. It doesn't matter if all those four things I said happened. Doesn't matter if it's below the 200-day moving average. Doesn't matter anything. There is no trading now. And not only that, if the trade opened here, so 3 days, so 5 days before earnings, the trade closes here. This is a no trade zone. If you have an open trade, close it. If you get a trigger, ignore it. It's the no trade zone. This is a never trade earnings trade. Okay. So now what I've done for you is I've told you everything that will trigger the trade to happen and when to get out. What I have not done is told you what this trade is. What is this trade? This magical trade. So we'll go down. It's a custom strategy. I'm going to click edit. So first I'm going to talk about it in words. By the way, Max, you'll see that we got this back to 30. So I'm going to talk about what it is in like option speak. And then I'm going to show you a picture of what that option speak looks like when it comes to a P&L. In other words, what exactly are you speculating on? Because these are all speculations, right? So let me pull that picture up before. Hypothetically, I should have had this ready, but I didn't. So let me look for the images. All right, I'll find it in a second. Here we go. Webinar files and images. All right. So let me first talk about it. Okay. So a few things I want to note about this strategy before we go over it. This is what we're looking at. First of all, it's all puts. Okay. There's no calls in this strategy. This is all puts. So no matter how complex this feels, I want you guys to remember something about option trading. It's very important. No matter how complicated something is, it's either a call or a put. Those are your only two choices. And you're either long or short. Those are your only two choices. That's it. That's the most complicated a strategy can be. Calls and puts, long and short. That's it. So just take a deep breath. It ain't that complicated. I'm not saying that you should do every trade. I'm just saying try to get over that mental hurdle that says, oh, this is impossible. No, it's not. It's calls and puts and it's long and short. That's all it is. Okay. And this is only puts. Number one. Number two, it has three legs. I'm doing three different things. I'm getting long a 37 delta put. So I'm getting long an out of the money put. And they're all the options are 30 days to expiration, all the same expiration. Okay. Hopefully this is showing you that it's not quite that complex. Same expiration, all puts. Okay. So you're getting long a 37 delta put, getting long and out of the money put. One time. Then you're selling, getting short a 25 delta put. That's even further out of the money. Three times. Three times. And then finally, in order to make sure you don't have naked risk, you're now, at this point in the trade, you're now short two options. So you get long and even further out of the money put two times. And that makes us long three, two, one and three, and short three. So this trade is covered. Okay, so that's what the trade is. And I say, well, what does such a thing do? What does such a setup do? This is what it does. This is what it does. Okay, if this is the current price, right? This line right here. And this is the 37 delta put, right? The 37 delta put is out of the money to the downside, right? You actually start making money as the stock starts going down. First of all, you make money if the stock goes to infinity. Wherever it is, you're making money. Green means you're up. Good job. You get your credit. This trade must be done for a credit. And this is the credit is what you receive if the stock goes up. If the stock starts going down, you actually make most. This is where your max gain is. It's at the 25 delta. But remember one thing about this. We're short three of these. So when we get here, no problem. But if it goes through this strike, starts going down fast. Right here is where our loss is capped. That's where we bought those two 10 deltas, those two 10 delta puts. Okay, so this is what your payoff looks like. So now think about it for a second. It's a stock which is in a correction. It's below the 200-day moving average, so it's a technical failure. It's asymmetric to the downside. Its tail moves are to the downside. This strategy makes the most money if it goes down even further. Makes just fine money if the stock recovers. It does the worst if the stock totally collapses. It's covered, so you're not going to lose everything. It's fine. It's a covered trade. You know your risk. But that's the idea. The idea is to take a stock which is in a correction, which is in technical failure, which is asymmetric to the downside, which has downside tails, and says, I want to make money on every possible thing up and to around the 20 delta, right? That's the 25 delta right there. And this is where I want to introduce the idea of delta as a probability. Some of you may know this, some of you may not, but a 50 delta option, which is an at the money option, has about a 50% chance of being in the money. So delta can be used as a probability in the short term. And if you're wondering why not in the long term, it's the difference between the normal distribution and the log normal distribution. In short periods of time, those two distributions are very similar. But you can go further. Like, what are the odds at any one time that a stock goes to a 25 delta put? About 25%. Said differently, there's a 75% chance the stock never gets here. Right? And if our loss starts right around 20 delta, it depends on the options, this trade should have between a 75 and 80% win rate. Right? Because there's about an 80% chance that this never happens. Or if you prefer, there's a 20% chance this happens. 20% is big enough that we want to cover this trade, right? We don't want to be naked short. So this trade should have, right, from there to there is positive. Anything from here over, we should make money. This trade should make money. That should be about 75 or 80% of the time. So when we do these back tests, let's look at the win rates. Is it true that we should be winning about 75 to 80% of the time? Are those the actual win rates? I'm going to leave this picture over here and we're going to take a look. Now that we know what we're doing, we're looking at a stock that's selling off. It's in a correction. It's in technical failure. It's asymmetrically down. It has fat tails to the left. And we're saying, I don't think it's going to go that much further down. If it goes a little more down, I'm in. I'm making even more money. I want to take this 80-20 risk because the stock is corrected enough that I don't think this 20% is going to happen very often. This, oh my gosh. Let's check it out. Strategy is already loaded. Now I want to do a portfolio. Every Trade Machine member has these portfolios. I'm going to do it in the NASDAQ 100, but I'm going to do it in 3 sectors. Here we go. So what we're testing is over the last 3 years, how did this idea of taking on a payoff that looks like this in a stock that is correcting, in a stock that is in technical failure, in a stock that is asymmetric to the downside, in a stock that has downside tail moves, what's the likelihood that that disaster is kind of over? Right? What are the odds that we're kind of over here? Should be between 75 and 80% win rate. And the question is not will we have 75 to 80% win rate? The question is, will the wins be big enough to offset the losses? Because these losses can be big and these wins can be small. So let's take a look. It's going down the list. If you want to get the ability to backtest 200 symbols at once, you need to be an annual member and you get your backtest speed is about 5 or 10x faster. If you're just a monthly subscriber, no problem. You can only do 50 tickers at a time and your backtest will be a little slower, but you can still do this. This is not limited to anyone. But if you want to be annual, essentially it's called a platinum member, please email support. You just email support@cmlviz.com and we just take your monthly price and multiply it by 12. There's no special thing. All right, my claim was between 75 and 80% win rate, right? Here's my chart. I said, 80-20. Yet the win rate is 85%. It's performing even better than the options would imply. And that means, at least in the last 3 years, in this group of company, the options mispriced the risk. We won 85% of the time. And in the month, it's a 1-month trade, the average trade was 28%. So in tech, relatively large tech, when it's correcting and it falls in technical failure and it's asymmetrically to the downside and the tails are to the left, you know what? That's when the bid comes. That's when institutions come in. Not for all tech. NASDAQ 100 is the 100 largest companies on the NASDAQ exchange, right? That's going to include companies like Starbucks, but that's Tesla, NVIDIA, Microsoft, Apple, Google, Amazon, right? Meta. Boom. Here comes the bid. And that's exactly what the strategy is designed to do. Now, what do I do now that I see this? I sort it by average trade, and I click the ones that I want to know when this happens. Those 4 technical events, there's no way I can track that on my own. I need a machine to check for me every day. So the ones that I want to know, I'm going to select. So KDP, 3 wins, no losses. Biogen, 1 win, no loss. I'll wait for something better. Marvell, SGen, Vertex, Monster, Microsoft, AZN, Illumina. So guys, what I'm doing is looking at the wins and losses. I'm looking at the average trade. That's all I'm doing. ADP 4-0, Atlassian 8-0, Ross Stores 4-0, EXC. So it's 3 wins and 2 losses, but look at the average trade. I'm cool with that. Regeneron, Texas Instruments, EA, Qualcomm, ODFL, CDNS, Lulu is a lot. IDXX, Honeywell, huh? I didn't know they were on NASDAQ. I thought they were not. Okay. NXPI, oops, close that. All right, so I'm just going down and picking the ones I like. Tesla's 3-0, cool. AMD 4-0. Right. So you just go down the list and pick the ones you like. Autodesk, Costco, 6 wins, 1 loss. Micron, 3 wins, no losses. Workday, Amazon, ISRG, Meta, like there's just a lot. Goog, right? Sorry, I got this over. So after you choose the ones you like, and you're saying, okay, Trade Machine, can you tell me when this happens for these companies? Because there's no way I'm going to be able to look every day at these four things all coinciding at once. Just click Add Alert. Your tickers are loaded. The technicals are already loaded. All you have to do is click Add Alert. I like to add a note to myself. This is spread the sell-off. And just for my own sake, I know that I'm getting it for the NASDAQ 100. Click Add Alert. 33 alerts were created. I just created 33 trades for myself, probably next year. Boom. Just like that. But I don't only want to look at tech, because if all of my trades are in tech, then if tech is moving in a certain direction, let's say this is only when this is obviously when stocks are selling off, right? If the stocks are selling off and all of my trades are this, then when tech is doing great, I have no trades from Trade Machine because this only happens when stocks are falling apart. So what do I do with that? Well, one version is to also look at other strategies, which we did in our prior sessions. But another is to recognize that sectors don't always move together. So let's do the same thing, but let's do it for financials. Let's see how financials did in this with this same idea of a trade. And remember, this is the draw, right? Should have a win rate between 75 and 80%. The losses are going to be larger than the winners, but the number of winners should make it such that the losses are overwhelmed. If not, then we know, hey, I don't want to do it in financials. It's not worth it. Okay. So let's see what happens. And there are some great financials, by the way. JP Morgan, Visa, like these are some great companies that I like to trade. NASDAQ itself. All right. NASDAQ is listed on the NASDAQ. How do you like that? All right. So here we are, an 85% win rate and an even better return. This is close enough to say it's the same as tech. So what does this tell us? This tells us that this thing we found where there's a bid in large companies, by a bid, I mean buyers come in when these large companies go down. It's not just in tech, it's also in financials. And that makes perfect sense. Institutions are going to buy large companies in certain sectors. Tech and financials are like the two sectors, right? When is there not going to be a bid for JP Morgan or Visa or MasterCard or Wells Fargo or Bank of America or Goldman Sachs when there's a sell-off or American Express? There's always going to be a bid. I mean, always is a big word. There's generally going to be a bid. So I'm going to sort this by average trade return. I'm going to start checking the ones I want. Oops. Start checking the ones I like. 2 wins. I think that's an insurer. 11 wins, 10 wins. Sorry. 11 wins, 5 wins, AIG. All right, let's get to some names that are more familiar. Visa only happened once. Good enough for me. um, some of these other ones. Amp Financial. Is Goldie in here? Here's Goldman Sachs. Right. Here's American Express, MetLife, Citigroup, right? JP Morgan, Aflac. Go down the list. Say, hey, I want to know when this thing happens for them too. So I click Add Alert. Same thing. Here they are. It's all set. I'm going to give myself the same note, but when I get my email, I want to know not only is this spread the sell-off, this happens to be in financials. So I know XLF is financials. So to me, that's a note. This is financials. Then I add the alert. So I've added 22. So guys, together we've just added 55 trades for next year. 55. Just in this very short period of time. Right? And you go sector by sector and see the ones you like. The one thing I wanted to show you is that if a sector on the overall level, on the high level, the summary level, doesn't do well, I personally don't start looking for the best ones. I just skip the sector. You don't have to do that. You can say, yeah, I don't care if the sector's bad. I'll take the ones that did the best. That's not really my thing. I like to know that there's a bid in tech, there's a bid in financials. And because of that, now I want to take the ones that perform the best because I know what's under there. If this wasn't so good, I feel like maybe I'm cherry picking luck. That's personal. You don't have to do it. That's why I don't do things like test the S&P 500. That's every sector. I don't care about that. I care by sector. All right, so that is my presentation tonight. That I hope I clarified what spread the sell-off is, when it happens, what kind of what it looks like, what the win rate should look like. It should be in the 80% range, 75% range or better. The losses should be larger than the wins. It's just that there's a lot more winners, right? If something has an 85% win rate, then there's 7 wins for every 1 loss, right? So this green part is happening 7 times. This red part's only happening 1 time. Yeah, it's going to get you good returns. Okay, last 2 things. If you want to talk to Max, not during live help, click on community, watch it load. You have to agree to the code of conduct. This will look a little different than your community. I'm beta testing the new one. Go here. He's at chat Uncle Pops. Say, hey Max, I have a question, and it is. Then write your question, and Max will get back to you. That's it. That's it. It's that easy, guys. So if you're not into live help and stuff, no problem. And if you said, hey, now I kind of want to see your prior things that you did, those other sessions, go to the Learn tab right here, live help sessions for TradeMachine. Click it. Tonight's will be, give Mandy a little time. Tomorrow morning, you'll have TradeMachine Guidance, blah, 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 12/29, 12/28, 2023. So we did buy the sell-off, pre-earnings, diagonal with AI, fade the dip with AI, and then there will be the one today, which is spread the sell-off with AI. All right, I'm done with my formal presentation. I'm going to stop sharing my screen. I'm going to share my video. So will Max, and we will take your questions live.
Beautiful presentation as always. I'm not obligated to say that, by the way.
No, he just gets a raise.
All right. Uh, we're going to focus on the chat. So I hope everyone is putting their questions in the chat.
Yes, please go to chat. Yes.
All right. We have a good evening, gentlemen. Happy New Year to all. May 2024 bring you happiness and good fortune.
Absolutely. I feel like we could just end on that. Well
Right.
said. Well
All
said.
right. Trader Susan is drinking wine. She wanted to make sure everybody knew that.
It's important. I feel that's fairly important.
Some people like my tie.
I like your tie.
Thank you. Um, for spread to sell off or any CML custom strategy, if the DTE choice is like today, 22 DTE versus 50 DTE, what does CML choose
Well, Max,
for
you tell.
closest to 30 days? It chooses closest to 30 days. So it would go to the 22. Skew means Val's smile is leaning towards puts, correct?
No, no. So this is a different skew. It's a really fair question, and it's an unfortunate reality that the word skew is used twice. It's this. This is just bad luck. It is true that in option volatility, the skew is the shape of the implied volatility across strikes. And that's normally what we're talking about with skew. In fact, for a very long time, I was a skew trader. The skew I'm talking about is relative to return distribution, right? It's how the stock returns have leaned. And in order to see what I mean by that, you want to go to the Learn tab, just type in skew. You'll see like an 8-minute video. So it's a
Yes.
fair question. It's a reasonable question. It's a high intellect question. It's a sensible question. That's just not the skew I'm talking about.
And I believe it's skewness, SKEWNESS is what.
Can be. It's also, if you prefer, the third moment of a normal distribution.
All right. Now
So
you're showing off.
the first moment is the first moment is the mean, the second moment is the standard deviation, the third moment is the skew, and the fourth moment is the kurtosis.
Okay, now someone's asking a question about handling a back test with AI criteria being met. And then a little later on, he says, disregard my earlier question. All back tests must have the Kurt condition satisfied to be triggered. Okay, there you go. So he answered his own question. All right. Handling a back test with AI. Okay, sorry. Isn't the 132 two put credit spreads and one debit put
Well,
spread?
it is
Yes,
absolutely,
it
you can
is.
think, absolutely. I didn't want to confuse people, but since someone brought it up, it's a 1 by 1 and a 2 by 2.
Right. There you go. Um, do some people call this a dragonfly? I've never heard the term
Yes.
dragonfly. Have you?
It's a broken wing butterfly.
Okay.
Worse. Yeah.
On the lovely risk graph, what does 80% profit look like? Is it 80%? This is a very important question. Is it 80% of the green zone? What is the risk that CML reports? Okay, this is the second part. So let's do the first part.
You want to bring the picture up and you talk about it?
Yeah, sure.
Okay. Okay. Go ahead.
I think someone may have asked a later question that answers this question. So it's the, I don't know if you can see my cursor, but it's the 80% of the credit received. It is not, it does not involve the triangular area as you start to approach
Right. So this is
the 25 delta short.
this flat area is basically the credit you received. So you know what, Max, why don't I show a back test and you talk about it? So let's just pull one PFG, doesn't matter. And I'll just do one. Here's a technical open. So this paid 272, sold 250 3 times, right? Which is 750, right?
Right.
So you're paying 272, you're receiving 750, and you're buying 30 cents twice, right?
So that's
That's a 538 credit. So this
right.
trade created a 538 credit. The 80%, the limit gain would be 80% of that. So if the 538 spread went down to $1.07, you would just buy it back. So you sold it at about 540, you'd buy it back at $1.
Yep. So the third part of the question is it the 80% of the green peak or the 80% of the green flat? And it's the green flat as we just discussed. What is the risk that CML reports in backtest results? I'm going to let you answer this because it's the most conservative calculation. And
Okay.
I've had some problems coming up with the number that we sometimes see as the overall risk. I don't necessarily look at it that
Here it
way.
is. How is amount risk calculated? We actually have it in the help tab. We actually give an example. We talk about on short puts, margin, naked calls. What does it use? What the requirement is? What about the spreads? What about when you buy options? Can you explain more? So it's all here. So rather than answer it, just go here and say max risk, not max as in max cats. And that's it. And you'll see it. Okay. So it's an answer which depends on the trade, but ultimately we take the most conservative view of risk.
Right. Okay. I'll interject that what I do um, on a practical matter is if I'm selling a put spread, for example, to keep it simple,
Mhm.
um, and it's a $5 wide put spread, and I'm selling it for $1, I have $4 of risk. That's the way I look at it.
Perfectly reasonable. Yep.
All right. Okay. Moving on. Sorry, disregard. How do you manage this trade when it goes against you? Now, there are multiple ways. Um, you'll note that there's no closing rule
On the down if it goes bad. Yeah.
if it goes bad. The only closing rule is either we run out of time or we achieve that 80% of the green flat area. What I do, and then Ophir can tell us what he does, what I do is if it approaches the short 325 delta, the first thing I do is say, well, how quickly did that happen? Because it's a 30-day trade. If it happened 20 days in, I'm not as concerned as if it happened in 2 days. If it happens in two days to a week, I'm tempted to take one of those short put spreads on the back end and roll it out and down. I'm also tempted if there's a lot of time left and I'm confident that the trade may turn around, I'll take some of my credit and roll down in the same expiration one of those short put spreads. That's what I do. What I never do if the if there's some perceived pain or actual pain happening, I will never sell out that long put spread, assuming that this is going to turn around.
Oh
That
yeah.
long put spread is your only protection against the short put spreads.
Don't
That's
what
what,
Max is saying, don't turn it into a trade that has unlimited loss at the very least.
all right, that's what I do.
I just let it happen. Yeah. I've actually missed some of them and then I mean and I get so all three legs end up exercising. So it ends up being a nothing, but I don't care. I mean, it's not that I don't care. I like to win on my trades, but I know when I look at my book, some of my trades are going to lose. I just let it happen. So,
Okay. Somebody's thanking us. They never quite understood the trade until now, so they're
oh,
thanking you, both
excellent.
of you.
Good. I'm really glad to hear that.
All right. Someone's saying the strategy is hard to believe because the results. It's hard to believe the results because it's favorable in every sector, but not great in XLP and XLRE. Um, I don't have a problem with that. I don't know if you do, Ophir.
No, just remember that those pre-built portfolios are all in the S&P 500. They're all large caps. Large caps, at least in the last 3 years, that was a 3-year back test. You can go back to 2007 if you want. In the last 3 years, there has been a bid in large caps, right? Large caps go down at some point, people come in and pick them up.
Right,
That's it's just a reflection of that. Now, if we had 3 years where that wasn't the case, won't look very good.
right. Someone's asking to confirm the 75 to 80% is better as I, I, I think it's negative skew moves back towards zero. Is that correct?
Well, I take this trade, I set up this back test such that basically every portion of the stock's behavior is bad. So it's corrected, it's down 10%. It's in technical failure, it's below the 200-day moving average. It's asymmetrically in the last 6 months downward. Over the last year, the tails are to the downside. So I'm looking for these large caps, which have in every way possible a bad looking stock. And when it gets bad enough, I say that's enough. That's enough. If it keeps going down, I'm fine. I just don't think it's going to have another like 2 standard deviation down move or once it like that's it. There's going to be a bid. If I'm wrong, I'll hit the max loss. So this is very much designed to be an ugly looking stock, which is, by the
Okay.
way, why I started the webinar when I said, remember, we also looked at other things like when stocks are going up. You don't only want to do this.
Right. Came in late, look for recording tomorrow.
Yeah.
Yes. Someone wanted to make sure that you picked COF, whether
Oh,
that's Countrywide Financial or
no,
Capital
no,
One.
that's Capital One. I worked,
Capital One.
did you know I was a trade structurer on Countrywide Desk, the largest trading desk west of the Mississippi during the Great Financial Crisis?
Was that your first job?
No, first job. God bless you. Um, Max thinks I'm so young. I just love that. He thought that was my
Well,
first.
everything's relative, right?
Everything's relative. That's true. Yeah, no, it wasn't my first job. It was my first structuring job. Yeah. So I was there.
Okay. Where are the previous videos? They're on the Learn tab. Just click on that Learn tab, and you will find the.
I'll show it one more time just because
Thank
Max is now upset. You've upset Max. Go to the Learn tab, go to Live Help Sessions for Trade Machine, and there you go. I was
there you
joking about upsetting Max. It's very hard to upset Max. I haven't upset him yet.
at this stage, it's very hard. So optimal to close trade if Delta 25 is hit. I don't think anyone said that. I
Well,
think
they were
it.
just saying that you adjust your trade at that point.
I start to adjust the trade
Yeah,
by
and I don't.
potentially moving one of the short put spreads.
Totally
Either.
reasonable. Yeah,
Yeah.
it's
All right.
personal. Yeah.
How would you compare contrast the results from doing the 1/3/2 ratio spread with calls versus puts? Two different two different trades.
Yeah, you would kind of turn that upside down, right? Your biggest loss would be if the stock goes up a lot.
Right. Right. Shouldn't have asked Max. Okay. This is not the skew you are looking for. I guess that was in reference to a previous question that we had. Love everything about Trade Machine. Please excuse this being off topic from today's 132, but I think you'll agree my question is important. My question is about the 14 pre-earnings with kurtosis.
Mhm.
There are two stocks that qualify now that have not appeared on the Today tab, TSM and JPM. Note,
There's no way JPM. Absolutely impossible.
well, the person is saying that JPM is 112.24 before market open.
What?
So, oh, now he's saying so technically JPM should print tomorrow on the Today tab. I don't know that these are all confirmed dates.
Let me just check. Yeah, that does not sound right to me. But let the person be. Let's assume they're right. Hold on. Let me just
All
check.
right.
I'm checking the date for JPM.
Okay, and also check TSM
Hey, no, no,
because
no. Hey, Ophir says when he's wrong. Confirmed the 12th. It'll be on
all
there
right, so
tomorrow.
we should see it tomorrow.
I was wrong. They were right. Yep.
All right. And then it says TSM.
Oh, well, I assume that's right too. I'm not gonna check now that I'm wrong.
Okay, but he said the person is suggesting that. Oh, okay.
Are
Is
we
it
done?
because TSM earnings date is not verified? That's exactly right. If the
Yeah.
earnings date is not verified, it
Right.
will not appear on the Today tab.
Then you won't. Yeah. But JPM is right. And it looks, yeah, TSM, that's just an estimate. I see that for the 11th. That's not. JP Morgan and the 1 year kurtosis is booming. So yeah, I think that's going to trigger.
Yeah, I look forward to that
Yeah, it
tomorrow.
means I probably have to put that trade on, Max.
There, well, got to end the year somehow. All right. Why do you like the 1/3/2 more than the 1/2/1/2 ratio spread? Um,
Yes.
we back tested it and it had better returns and slightly less risk.
Max actually
Um,
figured it out, to tell you the truth. I was a 1/2/1/2 guy for the last decade.
um, but it's, if you're more comfortable in the other trade, it's not significantly different, but there was noticeable improvement by switching to the 1/3/2. Any suggestions or guidelines on what premium we would like to collect in a 1/3/2 trade? Perhaps as a percentage of the spread of the strikes. Ophir?
I don't like to do a trade where my max gain, which is your credit, the credit is the max gain. Oh, no, it's not. Your max gain is if it goes down to the 37 delta, but or 25 delta.
25.
But for my credit, I don't want my credit to be less than 4 times the loss. So if I receive $1, I don't want to lose more than $5. The $4 spread. And why is that? Because this should have about an 80% win rate, right? So I want the loss to win to be about 80%, 4-1 or better. That's how I came up with that number, by the way. It was
Right,
didn't
right,
mean to be genius.
right. And then someone is now saying, "Oh dear, Max, not wild about your answer," referring to, I believe, the point I made about I never want to sell the one put spread that I'm long when I have a potential problem.
Okay, we got a
And then
speculator in here.
the same person said, "It's awesome that we can have different approaches."
There you go.
There you go. Would you suggest applying the 1x3x2 to stocks that are in their pre-earnings phase?
I would know.
No. Wouldn't these theoretically give you better than the 85% win rate?
No, so let me answer this one. So there's something called a theta paradigm, which is that we use on these diagonals before earnings. I really think you should watch that. So uh, so theta paradigm. Understand. You don't have to watch an hour 50. This is like the first 30 minutes or something, but like no, there's a very, very specific thing happening with this pre-earnings trades that are volatility trades that are very different than this spread. Very, very different. Fundamentally different.
All right. And then the same person who hated my answer to that question before is now chiming in that they like OG's answer much better.
Well, I mean, that's just natural.
In executing a ratio spread, if you can't execute one of the legs quickly, which leg of the trade would you execute first?
Oh, I would do it. I would do it. You can answer, but I would do it as I only do this together.
Okay, I agree with you, but I would say that there are some times, especially in futures, where you can't do all the legs at the same time. I always start with the hardest leg to fill, with the widest bid ask of that spread
That's
before
smart to
I
see because you'll
worry.
see if you want to do it otherwise.
Yeah, yeah. If it takes me too far off track,
Just forget
then
the
I know
trade. Yeah.
it's not, I should stop. Right? Okay. Someone is telling me that you can break the trade into parts. Of course you can. And they say you can close the PDS at max gain
I'm gonna,
and then
can I guess
the
can I
short
guess who is
one.
saying this? Am I allowed to guess?
You know who it is. Go ahead. We're not supposed to mention names, right?
No, I was trying to get you to say it.
Yeah, you want me to be in trouble. Um, I mean, thank you. These targeted sessions are allowing me to demystify the CML strategies. Is there an explanation of what typical market conditions, bullish, bearish, neutral, are generally best matched to which CML strategies?
Yeah, so in my opening slides tonight, you can go back there. It's like just like a screenshot. There's two strategies which are this one, spread the sell off, and buy the sell off, which are like when things are going poorly and we're looking for a recovery. A bullish one, we have a bullish burst one. We haven't talked about it yet, but like the pre-earnings diagonal, pre-earnings momentum, that's when the stock is above the 50-day moving average. That stock's in a good technical place generally. So that's a bullish idea. And then fade the dip is kind of in between. But we also have a MACD one, which is a bullish one. So we'll get to those. But of the four we've just done, we've looked at like when stocks are falling apart, when stocks are recovering, and when stocks are bullish.
All right. This is an interesting question. I'm a little worried that I'm trying to overcome. I have a little worry that I'm trying to overcome. Max Katz has a view of risk that I would describe as max loss, meaning maximum loss. I subscribe to this view of risk too. Ophir described this perspective as perfectly reasonable. However, it is different to the way TradeMachine measures risk. I am a little worried about TradeMachine not showing backtest results with the way I understand risk, and it is affecting my confidence in it. So I'll just quickly say, TradeMachine takes the most conservative formula for risk. It is higher risk configured in TradeMachine than the way I do it. All right. That you want to add anything to that?
What Max said.
Okay. So you can have confidence that if TradeMachine comparing to risk is projecting a 21% average trade or total return to risk, that our number is going to be higher the way we calculate maximum loss. Okay. Someone is now drinking more wine.
Someone.
Which of the trading strategies in TradeMachine might be useful for day trading?
You want to answer? I don't have a good answer.
I don't have a good answer for one of the canned strategies, to be honest. I'm
No.
still experimenting with a one-day trade opening in the afternoon and closing it the next day based on certain technical open criteria.
If you
But
figure it
it's
out,
not,
share it.
yeah, it's on either SPY or QQQ.
Yeah.
When it's ready, I will share if it has good results. Otherwise, I'm just going to tell the person who's drinking all that wine. The arc of trade journey. I think the max losses in the examples is what many traders have difficulty accepting. My experience opinion is that viewing the losses as defined risk and that the law of large number of trades should work. It's in Ophir's opening principles, this arc of the trade journey.
Right. Yeah.
Okay. What strategy works best in low vol times? And same for high vol times.
You don't want to hear this answer.
You don't want to hear it?
You can't go into answer. I'll give you the answer. Go ahead.
I can only say that in general, I won't mention specific strategies, but in general, in low vol times, I am not adverse to owning volatility. And in high vol environments, I prefer selling volatility. Now, Ophir will give you the definitive answer.
If the VIX is below 17, at low vol regimes, you tend generally just want to sell more vol. Just keep selling it. If the VIX is between like 17 and 22, that's really the only time you want to own vol. If the VIX is then above that, you want to sell vol again. So it's like sell vol, buy vol in a window, and sell vol again. When volatility is low, it's generally for a reason. Market's doing well, markets continue to rise, you sell it. Now, obviously, if you continue to sell vol in the low vol environment, there will come a time when it changes. Fine. But I'm okay with that. I'll win 9 times, I'll win 10 times, I'll win 11 times. Oh, I lost. Okay.
Yeah, as long as you're not winning a nickel nine
No,
times or 10
I've
times.
never placed a trade to win a nickel.
All right.
I don't think that's a good way to trade.
All right. It's not, but I can honestly tell you guys that at the early part of my trading floor career that I used to sell two delta options for one tick and do it 100 times. All right. Awesome session. The learning is cumulative. I didn't say it was right. I learned my lesson when they called me in and said, put $250,000 more in your account or get out of that position tomorrow. Awesome session. The learning is cumulative. I think I take 3 steps forward and 2 steps back. I need both my own testing and results to review and these kind of instructive Q&A. Thank you. Thank you. So, OG, this is a legit question. Did you look at 5% loss versus a 10% loss as generating more trades, I guess, for the 132 for spreading a
Oh,
sell-off? In other words, besides the 80% for wins,
I
cutting
I
cutting
think I
losses.
probably looked a little with stop losses, but I'm just so this is where we each have our own personalities as traders. And just remember, Trade Machine, while it has stuff built in for you, I mean, feel free to be your own Michelangelo, right? Make your own strategies. You don't need to use ours. It doesn't hurt my feelings at all. But no, I mean, Max will probably agree. When you trade enough, you've taken enough losses, you've taken enough winners, you've kind of seen the long arc of a career. This like frenetic pace of trading doesn't, it's just not interesting anymore. It's like you place a trade, you know why you're placing it, you know when you're going to close it, you know why you would close it, you have your plan, and you just kind of let it roll. Nothing should really surprise you. Yes, you have bad months. In fact, you're probably going to lose money 2 out of 3 months, 2 or 3 months out of the year. It just happens. You just try to make those months that are down not be like worse than like your fourth best month. You don't want like a bad month to wipe out your year. You just, you have your portfolio trades and like it just doesn't affect me like that. I don't.
All right. And this is not my question. I want to say that before I read this,
No, no, no.
but I have thought of this subject. So selling a 2010 put credit spread, not good? Question mark.
Well, you should win about 80% of the time. So you should win 4 times for every time you lose. The question is, are your losses more than 4 times bigger than your gains? My guess is probably. Remember, guys, if I wanted to just sell a million trade machines, I could show you a 90% winning strategy. I guarantee you. Sell a 10 delta call. 10 delta, or actually call or put. I win 90% win rate, right? Like on YouTube. I have a strategy with 90% of the time. I'm sure you do, dude. You've also probably lost all your money, and that's why you're doing YouTube videos. It's not hard to get probabilities on your side. It's hard to get edge.
I've lost all track of time, so I apologize.
Too much.
Um, okay. Ophir once said he doesn't have more indicators in the TM opening criteria because no others seem to make a significant difference to the back test outcome. What other indicators has he looked at? Please.
Yeah, for me, it's the AI I found that, and like I'm with moving averages like the 50 day, the 200 day, like that's enough for me. That doesn't mean the other ones don't work. It's not a judgment. It's just like for me, like that's it. That's all I need.
Right, right. Okay. One gentleman says, interested. I wasn't even supposed to say gentleman. Interesting. We buy volatility only for a good reason, such as pre-earnings AI. Yes, but even that pre-earnings AI strategy is a long call diagonal. So not only are you buying volatility 14 days out, but you're selling volatility 7 days out, both
And the
calls.
and the 14-day volatility you're buying is backstopped with earnings, so
Exactly.
it
So
decays
that
slower.
right, that theta decay is minimized until after the earnings event.
Watch the theta paradigm video in the Learn tab. Trust me, it's if you don't know about that, it can be
Okay,
revelatory.
we have 2 questions in Q&A.
Okay, do it.
All right. Love everything about Trade Machine. Please excuse this being off topic.
Oh, they already
Oh,
asked.
yeah, yeah,
Yeah.
yeah, yeah. Okay. I guess they repeated it.
Yay, we're done with Q&A.
Okay, both of them are repeats. There we go. Beautiful. I wish, I'm sure Ophir wants to have a closing message. I wish everyone a happy and healthy New Year's. May 2024 be only a healthy and happy time for you and your loved ones.
Absolutely, I echo that. And we have a CML Pro webinar this Saturday, 11 a.m. Pacific, 2 p.m. Eastern. If you're not a CML Pro member, why not? All right, guys. Have a fantastic new year, and we'll see you later. Bye, guys.
See you. See you on Saturday.
Okay, see you, Max.